Chameleon user and a big member of the Discord group. I actually created the Discord with the doctor, aka Jake, who's a big member of the Chameleon community. If you're joining us for the first time, my name is Will McBride. I'm one of the co-founders of MarketChameleon. And my guest tonight is Raj, an active Chameleon user. Before he comes on and we get started, why don't we start with the disclaimer, which you see on the screen. Just so you know, neither Raj nor myself nor MarketChameleon are broker dealers. We are not registered investment advisors. Everything we're giving you is for informational purposes only. So take a moment to read that disclaimer. Now, with that, Raj should be joining any moment. He's coming. Here he comes. And there he is. Raj. How you doing, Raj?
Good. How are you?
I'm great. For those who don't know, Raj is one of the great chameleons. He's super helpful to the community of MarketChameleon users. He and a fellow active user, Jake, are very big with a Discord group that Jake created. I will put the link to that in both the YouTube chat and the Zoom. We are doing this on 2 platforms tonight. People are coming into the Zoom right now. People are also already in the YouTube chat. So I'll put the link in there. If you have questions, just pop it into the chat. Or if you can get over to Zoom from YouTube with the link I provided, or if you are on Zoom, you can ask the questions live. Correct, Raj?
Yeah. You just have to raise your hand in Zoom, and we'll can put you on.
Yep. So raise your hand. You don't have to turn on the video. If you're brave enough to turn on the video, I would love that. We haven't had one person do that yet.
Well, actually, you know why that is the case? Because your webinar doesn't allow you to turn on the video.
Oh, so that's something I have to set up.
Yeah, you have to set it up.
Well, if I had enough, because we've taken this idea, Raj came to this idea of asking the questions live, which when done are super helpful because they can really get a deep, thorough answer out of the question. But every morning, Dimitri, my co-founder, every morning he loves taking live questions. And we've had probably 30 live questions, but they don't, most people like putting it in the chat, prefer putting the hand in the chat. Actually, we have someone raising their hand right now. Glenn, you raising your hand? You already have a question. We haven't even started the webinar, Glenn. You see that hand being raised by Glenn?
Yeah, I see it, but it might be a technical issue. Yes.
All right. Well, anyways, let us get going with the webinar. Let us know, everyone, that you can hear us. Again, my name is Will. I live actually in Bucks County, Pennsylvania, and Raj is on the other end of the continent, I think, Raj, right? And maybe in another country.
Yeah, I am in Canada, in Western Canada, in Vancouver.
So to let us know you can hear us, just type where you're from. It's always interesting to hear where the individuals attending the webinar are coming in from. If it's your first time, welcome. Let us know it's your first time. Again, we do a live morning show every morning on our YouTube channel. I'll put the link where you can register for that. I'm sure you've seen the emails. That is always a good opportunity to ask questions as well about anything in the Chameleon world. We have Glenn from Kentucky. Thanks for joining us, Glenn. There's Raj from BC, Canada. We have Stefan from Toronto. So we have some active
Canadians here. Good.
Canadians here.
Mm-hmm.
And we have no one on the YouTube chat willing to let us know where they're from. But thanks for joining, everyone. And with that, Raj, we're about 5 minutes in. Why don't you get started with your presentation?
Yeah, so let's start. So our topic today is Introduction to Options Greeks. Anybody who does options trading knows about the Greeks, and so we are going to look into Greeks and how they apply to spreads, right? So for naked options or single-legged options, everybody know how the Greeks behave. We'll go through a small intro. This is not going to be in-depth introduction to the Greeks, but we'll just go through a little bit and then we'll dive into the topic. So, and I'm going to be using Thinkorswim to do some simulations. So there are 5 main Greeks, right? Delta, which is the most important Greek, represents the sensitivity on an options price to changes in the value of the underlying security. So let's say the underlying security is $100 and the option costs $2. and the underlying moves to $110, how much is the option price going to move? And that is determined by the delta. The theta is represents the rate of time decay of an option. So as everybody knows, options as different from the underlying are volatile contract, is in the sense that they are always decaying in value, which is good if you're a seller of options. So you sold an option, and if it's decaying in value, you're collecting money every day. But if you're a buyer of option and the option is decaying, you're losing money every day. So if you're a net seller, you're gaining by theta, and if you're a net buyer, you're losing. And I like to use the analogy like an option is like almost like an ice cube in your hand. And the longer you're holding it, it's constantly melting, right? So you have to keep passing it on and deal with it quickly. And as it comes closer to the expiry, the theta accelerates a lot more. Okay, next Greek is gamma, which represents the rate of change of delta. So this is the rate of change of delta. Let's say if the underlying is at 100, so the strike price 100, and if the strike price is 110 or 120, how much does the delta change? The rate of change of the delta is measured by gamma. And vega, which is the volatility, so it's option sensitivity to the volatility of the underlying, that's measured by vega. And rho, which we really don't deal with much because it's pretty much standard, it doesn't change. It's just the rate of interest, and that has a very negligible change or influence on the on the options prices. Okay, so going to so with that we'll go into the Black-Scholes model. So even before the Black-Scholes model came about, options were still traded, but it was very, very cumbersome to calculate whether the option is overpriced, underpriced, or what the pricing should be. So this was a very revolutionary thing that happened. Three scientists, I think it was three of them, who came up with the Black-Scholes model to explain the pricing of options. And with that, options trading went through the roof in the sense that it became very, very transparent, very liquid, and the bid-ask spreads and all those things started tightening up because the traders, market makers, traders, everybody had a model to explain the pricing of the options and calculate the risk and reward and all of those kind of things. Okay, so that's the one, that's the number one. So we'll look into that, and then the second thing is like Greeks and naked options. We'll go through that, and Greeks and spreads. So spreads are essentially multi-legged options. So naked option is like buying a call, buying a put, or selling a call, selling a put. And spreads are where you do at least two different legs. So for example, a bull put spread would be selling a put and buying a put, right? So that's a spread. So let's look at the Black-Scholes model. I'm not a mathematician by any stretch, so I know really enough just to get me into trouble. I'm an architect by training, so I don't like numbers that much. I'm more of a visual person, so most of the stuff I'm going to show and do is going to be visual. But anyway, I found this, there's a lot of Black-Scholes calculators out there on the web, but this one is pretty simple to understand, so I'll show this one. Okay, so I'm just looking at this. So let's say I was looking at this from the point of view of NVDA, the strike price, and we'll calculate, we'll see how it works, okay? So this is MarketChameleon website, and this is the dashboard, and I'm looking at the most active options, and we see NVIDIA, so NVDA there. And let's look at, I'm going to go to the options chain. So this one, bull put spread, right? So there is one being recommended by MarketChameleon in the sense that it has calculated the trade card, and we have a win rate, a theoretical edge that's calculated. And so this is a bull put spread, right? And this is the 7th of January expiration. We are selling the 290 put and buying a 285. So let's look at this on MarketChameleon. So once I click on this button here, option chain, this will open a separate tab, and it will take me directly to the option chain of NVIDIA. So it's taken me to this page on NVIDIA, and it has already populated my strategy with these two legs, which is selling the 290 put and buying the 285, right? So it's done this. This is 12 days into expiration. So I'm going to load this strategy. And this shows us the profit loss diagram or the PNL, or what is it called? The payout diagram or the profit loss diagram for this. So what I want to do is I want to just do start with simple things. So we're going to just start with, let's say, the 285 call. Okay. So the 285 calls are on this side, and I'm going to buy a 285 call. Okay. So 285 and the price is 1600. So I'm going to load the strategy here. Okay. So this is what the profit and profit loss diagram for a naked option, which is if I buy the 285 call, looks like, right? So for me to start making money, the underlying has to move. This is the break even, $300 is the break even, right? So if it starts moving above 300 before expiration, if it closes at about 300 before expiration, then I stand to make money. Okay, so now let's look at this. I'm going to just change the display of this to, let's say, 10%. So we get a bigger diagram here. So if the underlying, I bought this option, so there is a theta, right? You can see here for this particular strategy, we have all these Greeks here. You have the pricing, the bid-ask spreads, and you have the strategy Greeks. So here we have the theta, which is negative. That means every day, this has got 12 trading days remaining. So every day, this particular option is going to lose $37. How much am I paying for this? I'm paying $16, right? 16.5, which is a debit. So I'm paying for this. So I already start off with net in the red, basically, because I paid for it, and I only gain if the stock price goes up, underlying price goes up. Okay, so and on top of that, so for a single contract, so this is my net loss, 1650. You can see that bubble that pops up, 1650. That's what I paid, and out of that, I'm going to be losing almost $40 every day. So that's the theta. So now let's look at how this is priced. Now, if you want to see that the market is pricing this particular option, it's asking 16.5. And if you want to sell this at 16.4, and this is a theoretical model, you can check out different theoretical models out here. So let's say underlying volatility, I guess, for the theo column. So let's say we pick another metric. Okay. So the theoretical column now will change, right? This one. So this is based on MarketChameleon's models. So we are just going to use the default here. Okay. So 16.5 is what it's asking. Now let's try to use the Black-Scholes formula and see how much it would come. So the underlying price right now is 290.75, and we are looking at the 285 strike. So let's go to this calculator. So 290.75. We don't have to get that accurate, but look at that. So 285, time to expiration is 12 days. I can use months or days, but we're just using 12 days here. Volatility, that's the volatility for that particular option, you can see is around 52. So let's put that in. So 52%. Risk-free interest rate, I'm just going to leave it at 1. It doesn't make much of a difference. So dividend yield, just leave it at 0, and I'm going to say calculate. And according to this now, it says the call price should be 13.99, so $14. So the market is actually, pricing it at 16 something, so a little bit difference. So let's look at another strike price. So let's say 210, which is way out of the money. So 210 is $82 because it's in the money call. So it's way more expensive. And I'm going to remove this one. I'm going to remove this particular leg, and I just want a single call. Okay. So let's look at this. And this one, you can see that the current spot price is here. So if the price goes above, my break even is somewhere around here, 292, right? So as long as the price goes about 292, then I start to make money, because this is a deep in the money option. And you can see that it has got a delta of almost 100. That means it moves in sync with the underlying, because it's way out of the money. So if the underlying moves to $1 higher, so it becomes 292, for example, this call price option, I directly gain $1 because it's got a delta of 100, right? So it moves in sync. So now let's use the Black-Scholes model and see if this pricing is correct. So it is priced at $82.3. Okay, so let's look at this. We'll use a 210 strike and calculate. So you can see that the pricing of the options is very close to how the Black-Scholes model predicts, right? So that was the genius of the Black-Scholes model, that they could actually calculate all of the pricing, and there was an explanation for it. So let's look at, in this one, what the price of an option, what does it include, right? So it has all of these different components. So if I scroll down on this, you can see there's a delta, gamma. So it's got a delta of 1 because it's way in the money, this one. And like the other one, we said 285. Let's look at that, 285, calculate. And that was around $16 in the market. And according to Black-Scholes, it's $14. So let's look at that. That's got a delta of 0.6. So it's sensitive to the underlying by 0.6, basically. So if the underlying moves $1, this will move 0.6. So let's look at what our pricing tells us for 285. So we'll go in here and we'll make this 285 strike. Just going to go in here, load the strategy, and you can see the delta is pretty accurate according to the Black-Scholes model. Okay, so this understanding this Black-Scholes model is pretty handy to understand how the options are priced and what are the different components or all of the derivatives or derivatives of the option, like the delta, gamma. How do they factor into the price of an option? Okay, so let's look at that. So naked options and Greeks and spreads. So let's look at this now. So when you're doing multi-legged options, things get a little more complicated and a little more fun. And we'll see how the delta, how the Greeks get affected when you do a spread. Okay, so I'm going to go back to the dashboard on Market Chameleon, and we'll look at NVIDIA again. So let's see the top 3 by edge. So here in the strategy drop down, so these are the top options that if we were doing only, for example, bull call spreads. So these are the top 3 ones that Market Chameleon has filtered out, right? By win rate or by the edge, right? So if we say top 3 by edge, so these have the maximum edge, right? If we say top 3 by the, if you don't care about the edge so much and you want a more safer option, you can look at, so this one, for example, has got a 50-50 chance of winning or losing, right? This one has a 70% chance of winning. So let's look at by win rate, and you'll see like this one is way safer because it's a bear call spread and it's way out of the money, right? So you have 95% chance of this collecting this premium and basically winning on this one. Okay, so let's look at we'll start analyzing a simple one. So we'll go to this particular drop down, and so in this drop down again, you can, if you prefer some kind of strategy, you can always, let's say for example you want credit and condors, it found one credit and condor. If you want debit and condor, it hasn't found anything. So there's no strategy that Market Chameleon found that you can win with this particular strategy. So you can use this drop down to select a strategy. So I'm just going to put top 3 by win rate, and we have this bull put spread. So which is a credit. So you're getting a credit for this. These are all the numbers that you can see on the trade card. You have the win rate, you have the edge, and you have the theoretical value. So right now you're getting credit of 1.85, but Market Chameleon say that it should actually be 1.36 according to the theoretical model. So you're gaining you're getting an edge of 15.8%, right? So you have that edge, and plus you have the win rate. So you have two factors working for you. So let's look at this. I'm going to close this particular tab and open the option chain. So it opens a new tab here. And we should have that particular bull put spread already, the legs of that, which is we are selling the 285 put and buying the 280, right? So selling the 285 and buying the 280. So let's load this strategy. And you see that this is a simple payout diagram. And right now it is in the money. So our current spot price is 290 point something. And if the NVIDIA stays at this price or it moves up, or the underlying price moves up, you basically make money on this. So now let's look at the Greeks for this particular spread. Hey, Will?
Yep.
I'm okay on the speed. Any questions?
Yeah, no, it's perfect, brother. Very
Okay, good. Okay, so this has got a delta of 5.8. What does that mean? Basically, it means that for every $1 increase in the underlying, your option is going to increase by 5.8. So you've got a delta of 5.8, right? You have a gamma of -0.1, which is negligible, and you have a vega. So if volatility goes up, because it's a net credit, so net credit means basically you want the volatility to be high. So if the volatility goes even higher, you lose money, right? And if the volatility goes lower, then you gain money. So because the vega is negative. And the theta is 0.6. So every day, so this is, we got 12 trading days, right? So in 12 trading days, you're losing 0.6 every day. So out of the 1.85 or 185, you're going to be losing $60 every day, right? $6 every day, sorry. If you multiply this by 100, sorry, $60. So that's how the Greeks line up. Now let's look at, let's say this is what will happen at expiration. If the price stays above, which is your break even, 283 and above, you're going to be making all of this money. But let's say you want to close this before that. So you've got 12 days until 6th of January, because this is on 7th of expiration is 7th of January. Let's say you go up to 31st of December, right? And that's, you want to look at the payout diagram on 31st December. So you'll see a dashed blue line pops up. And this is the profit loss diagram as it stands on 31st of December. So you already made some money here. So as you go closer to the expiration, you'll see that this line, the curved line, starts, merging into this line, which is the profit loss diagram. That's because of the.
Hey, Raj.
Yeah.
We have a question from, and I won't butcher that. I won't even try on the name. It's my fault.
Sure.
I'm a terrible pronouncer of names. It's saying if theta is positive, you gain, correct?
Yeah.
And if theta is negative, then you will lose.
Exactly.
All right.
Yeah. So
there you go.
Yeah. So like in this option, I'll explain right here, because you are getting a net credit. When you see a net credit here, the theta is not always positive. So it is positive in this case because your spread is already in the money. So if it stays in this place, you are gaining that much every day. So like I'm showing you in this diagram. So as you come closer to the day, so this dashed blue line starts coming closer to this. That's what the profit you're making. So if you close this out on 4th of January, you will see you'll see a gain of if volatility and everything else remains the same. If volatility goes down, you'll make even more money. But with current volatility, let's say if IB goes down, right? So I'm going to just reduce the IV here, so the minus, and let's say load strategy. You'll see that on, what was it, 31st of January, you'll see that the blue line is actually now merging. You're making more profit because you collected, you collected a bigger premium because the volatility was high. And now that the volatility is reduced, you're basically profiting from that. So you're profiting from decrease in volatility as well as the theta decay, right? So let's just do this. So as we start coming closer to the expiration, you'll see that this blue line quickly starts merging into this, into the profit loss diagram because of theta acceleration. Because the closer you come to the expiration, your theta will start basically decaying a lot more faster. Okay, so as you can see that 1 day before the expiration, it's almost as good as full. And if you go to expiration, of course, the next day, this it's going to make this jump from here to here. So you can see that up to 10 days, it was slowly creeping up towards your profit, and full profits you get on the expiration day. If you don't do anything, you collected all of this premium, right? And these options have expired worthless. And because you got a net credit, you get to keep all of that money. Okay, so looking at this in a visual way, let me show you. I'll go to the next slide. So this is just a slide showing what, if you are a mathematics major or whatever, you'll understand this. But this is the formula for the Black-Scholes model, and this was a revolutionary, and this happened, I think, about 25 or 30 years ago, and that changed the options market and it changed the equities market forever. Okay, so what are the factors that go into it? So you have the call option price and the strike price and today's time, and then you have the stock price, this S, and the strike price, K. So the stock price and strike price, and then you have all of these different multipliers for that. And that's how the option price is determined. Okay, so you can see that the major factors in the options pricing are the price of the stock, the strike price, and what is the time remaining. So this T is time left till maturity, right? So those are the major factors. Now this is another visual which I had done in another webinar, but I've just reused that slide. So when you look at a premium or the stock, when you're buying or selling option, basically premium, it has two components: an intrinsic value and extrinsic value, right? So intrinsic value is determined by if the option is in the money or out of the money. So at the money, out of the money, and in the money, right? Extrinsic value that means the remaining value. So amount, this is the amount in the money. So for example, you have an option to buy a stock at 90, whereas the underlying is trading at 100. So you're already making $10 there, right? If you have the option, if you exercise that option to buy you can buy it for 90. So you already have $10 intrinsic value. Extrinsic value is the remaining value, and it's affected by the volatility the volatility is underlying and the time remaining, right? So this is how the components of an options pricing. And this same thing expressed in a different way. So let's say the total price of the contract or the option is 2.07. So $2 out of that is the intrinsic value, for example, and 7 cents is the extrinsic value. And this can change depending on whether it's in the money, out of the money, how much time is remaining for expiration, and all of those kind of things, right? So here you can see that the value of the option, intrinsic price, and extrinsic value is determined by time and volatility, right? And the intrinsic value is dependent upon the spot price, what is your exercise price, cash flows of the underlying, which means if there's any dividends incoming or outgoing, and the risk-free rate, which is the interest rate. Okay. So that was just an intro to the options pricing. And as I was showing you the Theta Decay, so here 60 cents. So how does that work? Just visually represented. So call option as a function of time to maturity. So here on the x-axis you have time to maturity, and on the y-axis you have the call option. So we are looking at call options theta, right? So those dark blue line, or actually purple line, is the at the money call option, at the money option theta. And so you can see if it is about to expire, so we have very little time to expire, the theta is very high. We saw that in how how it decays much faster as you come closer to expiration, and as you go further away, it's more flatter. So this is for at the money. So the at the money options are most sensitive to theta. So this basically shows you the sensitivity of the option price. The in the money call option behave this way. So, and the out of the money call options are least sensitive. So they're almost flat, but closer to expiration, everything loses. They lose value because they're out of the money. So the theta is 0 at that point. Okay. This one is the 3D representation. Well, this can be a little bit confusing. So let's just go to an actual demonstration, and you'll get to see this. So let me go back to this one. So I showed you on Market Chameleon how you can analyze and look at this, and at a glance, this tells you for this particular strategy how your delta, gamma, omega, theta, rho are performing, right? Now let's say you have an outlook that the NVDA is going to be range bound. That means it's not going to go too high and not too low. So we have our lower strike is 285, which is $5. So let's say it's going to stay in a $10 price range. Okay. So we will now convert this particular vertical into a different kind of strategy. So you have a bull put spread here in this case. So you're gaining by NVDA moving up, but you think that NVDA in 12 days is not going to go past, let's say 295 or 300, right? So we want to convert this into a delta neutral strategy, right? That means that and you want to just gain by the theta. So you want to increase your theta and reduce your delta. So we will convert this into one of the most common or popular delta neutral strategies is an iron condor. So let's just do that and see what happens to this. So we have, it is about $5 distance from this. So from 295, which is, you can see these two lines is basically, these are in the money options between these two lines, and these are out of the money, right? These are at the money. And these are out of the money. Basically call, this is out of the money and this is in the money. The call side and the put side, this is in the money and this is out of the money. So let's do, we are doing puts on one side, the one wing of the iron condor. Yeah, this left side wing is made of puts, and we are doing a credit iron condor. So we're going to do calls on the other side, which will be, we will sell the 295 and buy the 300. So I added two more legs to this. So I'm selling the 295 call and buying the 300 call. Okay. So now let's load this strategy. So this diagram doesn't change until you hit this button again after making changes, right? So now you'll see that this is now looking more like an iron condor, right? So these strategies have got interesting names because of the shape of the profit loss diagram. So you have, butterflies. Butterfly looks like this, and then you have the debit iron condors, and you have the reverse butterflies, and verticals are just, they have just simple vertical lines like this profit loss diagram. Okay. Control. Okay, so now let's look at look at how this has changed. So you can see now that the strategy Greeks, now we have 4 legs on this particular option strategy. How are we doing on time? Okay, we are good on time.
Plenty of time, Raj.
Yeah. So we have 4 legs, and now Market Chameleon is calculating what are our strategy Greeks. And based on this, you can now make a decision, right? Or this is one of the factors that helps you make a decision. So you can see now delta is almost 0. So it's close to 0. That means and you're collecting a credit, you double the credit of almost what you collected. So you're collecting $3.8 per this thing. So $380 essentially. So you're $380. Yeah, so you can see that in this pop out, your profit is $380. So what do you for you to make maximum profit? You want the stock underlying to stay between your 2 break evens, which is let's say the break even here is around 300, and here is 281. So as long as it stays between 281 and 300, you're going to make profit. Max profit will be, of course, between your 2 strike prices or the short strike prices, which is between 285 and 295, right? So 285 here, this corner, and this corner, which is 295. So if it stays between this, you make max profit, 380. If it goes above your break even, you're going to start losing money, and here you're going to start losing, but you are capped out at your loss. So the max you're going to lose is $120, right? And what you gain is 380. So that's that's what this is telling you. So now your theta has increased. So your basically theta is 1.2. As you saw from before, I'm just going to copy this link. I'm going to duplicate this slide so I can show you the other strategy and compare it. So I just copied that link from there just to fasten the process. And we'll go back to that. So I'm just going to remove these legs, which is the call side legs. I'm going to remove this one, load the strategy. So we can just compare these two. So you can see your theta was 0.6, your credit was 1.85 on the bull put spread. And on the iron condor, now you have a theta of 1.2. So you are gaining more rapidly from time decay. And your credit is 3.8. So let's look at this now again. Closer to expiration, so let's say 31st of December, right? Or actually, let's make it 5th of January, which is just 1 day before. So you'll see that now this is your profit loss payout on 5th of January. And for this one too, we will do 5th of January, right? So you'll see that it's coming closer to the profit loss diagram. But for an iron condor, you'll see it starts merging into the iron condor here. So this is telling you that your gain is going to be a lot more with this particular, because you have a higher theta, right? Your vega is also going to be vega is the same. I guess the vega risk is the same. Your gamma risk is the same. And your delta here in this particular case, which is the bull put, you have a delta. So you want the stock to move up, right? Because your delta is positive. In this case, your delta neutral. So even if the stock doesn't move, you're still making money just from the decay. Okay. So this is how you use this Greeks. So now let's do the same thing on the broker platform, and we will use, so there are lots of useful tools here on Market Chameleon where you can analyze your strategies and simulate different situations. Let's say, for example, you want to make this like a more bullish iron condor. You think that the stock is headed up, so in 12 trading days, it's going to move higher. So let's say your range is between 290 to 305 or something like that. You can move the strike prices. So Market Chameleon makes it very simple. So you can just shift the strike prices from here, one higher. And so I just shifted it a few times, and we'll load the strategy now. And you will see that the iron condor has now shifted to the bullish side. So you want now the price to land in this profit zone or the cone of profit here. So it has to actually go past 293, and of course you make more money as well, and you stand to lose here. Now this has become an uneven iron condor because it cannot find strike prices exactly matching that. So it's jumping one strike price. Now this should be more even. So you have $5 spread on the put side and $10 on the call side. So you have more risk on the call side. You have a $10 wide spread, and here you have $5. So that's an uneven iron condor. Anyway, so you have lots of tools here to do your simulations. I'm going to go back to our original one. I think it was one here. Okay, so this is the one we had.
Hey Raj.
Yeah.
We did have a question from a new user.
Sure.
And they're willing to come on live and ask it.
Oh, sure. Let them come on.
It's more asking maybe to pick your brain about they had a spread, and when it breaches the strike, they want to know how you approach it, maybe what you look at. Are you comfortable bringing them in?
Sure. Yeah. Let's do it. I was going to go to think or swim, but yeah, we can still do that.
Yeah, a live question is always exciting.
Sure.
So.
Let me see if I can help it. If it's complex question, we may not have time, but I'll try.
Yeah, and again, we do a morning show. I put it out a couple times because there were a couple off-topic questions. Every morning, Dimitri, who's really the brain behind the system, and he and I traded together for years, but he really conceptualized what you see in this platform. So he takes questions live every day from 9 to 9:30, as well as he takes a look at the market. So it's well worth your time, anyone, if you have time between 9 and 9:30 during the trading day.
For beginner chameleons, it is very much not just for beginners, for everybody, because he shows new features, he shows you things. The market chameleon is so vast, and there's so many ways to use it. And it's a fantastic research tool. So there's no way that any one person is going to know everything, except for Dimitri, of course. He knows everything.
Yeah. Well, no one knows. I mean, everyone brings him. It's amazing because we have thousands of Chameleon users on the premium platform, and millions who use the free version. And still, it's amazing. Every week, someone comes up and they're using the Chameleon in a way we never thought of. So that's how vibrant the tool has become.
Yeah, I've been using it for more than a year now, and every time I find I never knew Chameleon did this. I never knew there's so many pages that I didn't even know exist.
Yeah.
Amazing.
Actually, Rob this morning was saying he likes coming in to your webinars because of the way you navigate around MarketChameleon. He thinks
thank you.
Never seen anyone use it as efficiently as you, the way you tab around the product. He loves that. But anyways, we're running out of time, so I'm going to let
sure. Yeah, bring him on.
It's Serenavas. I think that pronunciation is probably wrong, but here you go. You're coming in.
And if you make them a panelist, they can turn on their video too. You can just directly promote them to panelist if they want.
Well, they're on. Are you there?
Yeah, can you guys hear me?
Yeah, yes, Srinivas, I can hear you.
Thank you, sir. First and foremost, please accept my gratitude. You guys are doing a fantastic job. You're helping the community. Super. Really, really appreciate all the work that you are doing. The question I have is, even with these iron condors, right?
Yeah.
Usually my approach is always I leg in. I first start with either on the put side or on the call side, just the one, and see how that goes, and then add the other side to make it an iron condor in general.
Sure.
But I've seen, many times the biggest challenge that I always faced is either one of these sides always getting breached.
Yeah.
And usually if that happens just when it is about to expire on the last day or just a day before.
True.
It becomes so challenging, and the losses are so huge than what premiums we're collecting. So I was curious to see if you have any ways we could protect and come out of that still kind of situations using the data that MarketChameleon presents.
Sure.
That'll be an incredible help, sir.
Okay, that's a good question, and it's a little bit advanced topic, but I can do that, and actually that allows me to now go into my broker platform, and I can actually show that how I deal with it. There are different ways of dealing with it, and legging in like you do, Srinivas. I think I do that too. I start with the vertical, and then I'm monitoring and market, then I can convert a vertical into an iron condor. You can make adjustments to iron condor, and actually did a webinar, I think, on iron condors and adjusting them. That was probably my last one, but you might want to look at the recording on YouTube. So let's recreate
Usually,
this.
how many days do you, I'm sorry to bother you, sir.
Sure.
How many days usually the expiration you do the iron condors? Because I usually used to do 7 DPs and,
Yeah, for iron condors, because of the gamma risk, you don't want to be too close. As you notice, as you come closer to the expiration, there's a huge gamma risk. And the little bit change in the underlying is going to affect your price. So I typically like to do at least 15 days expiration, 15 to 60 days, as much as 60 days. It depends on many factors like the underlying, the volatility, what the market is doing, things like that. But let's just look at this one, right? This is one recommended by Market Chameleon, which is expiring on 7th of January. Actually, let's look at just iron condors here. Okay, so credit iron condor, and let's, this is the one recommended, but the one I created, let's look at this one. So which is 295.30 on the call side and 285.280 on the put side. Okay, so I'm going to go to my broker platform, go to NVIDIA, and 7th of January, right? So this is the options chain for NVIDIA, and it's right now at 290. So I'm going to go, I'm going to sell this vertical, right? I'm going to sell a vertical. So I'm selling this one and I'm buying the 280, right? I think that was right. Yeah, 285 and buying the 280, right? So, so go back to this. So I'm going to so did this, I'm getting a $2 credit according to yesterday's pricing and analyze the trade. So once I right click and say analyze the trade, now I'm taking it to my analyze tab in Thinkorswim, which shows me the profit loss diagram, similar to Market Chameleon. And here I'm going to set my expiration, the date to January 7th, right? So this is the date. And now you can see that this light gray background in the back is telling me 1 standard deviation. So if I say if 2 standard deviation is this much move, so let's say 1 standard deviation, which has a 68% chance of probability, right? So this is where it's going to be, and these price slices are 10%. So this is what my bull put spread looks like. Now, if the price keeps going up, and if let's say I think that it's not going to go beyond a certain level, let's say what did we pick? 300, I think, or 295, 300 as the other one to make it into iron condor. So let's look at our Market Chameleon, 295, 300. So now to make it into an iron condor, I'm going to add the other side, which is the call side. So I did the put side, 285 to 280, and then I'm going to do 295. So I'm going to sell the vertical on the call side. So which is I'm going to sell 295 and buy the 300, right? Analyze this one. So now I have made 2 different trades and now converted this into an iron condor, right? So, or it's actually a tallish iron condor. So you can see that as long as the break even stays between 281 and to around 300, I stand to make money. So now let's simulate this on the Thinkorswim. Okay, so you can see now Thinkorswim is also giving me all the Greeks here. So this is my current price, right? And these are the slices at 10%, at minus 10%, plus 10%. These are the different Greeks. So right now my delta is almost 0, very close to 0 too. You have theta, which is positive. That means I'm gaining every day $26 on this, right? So max profit I make on this, this is 10 contracts. So 4,070 and max, you watch the numbers here on the bottom left. And it's 930 max loss. So you can also see them shown somewhere here, I think. No, not here. Okay. So you can, so as this is the price axis, and this is my profit loss, right? So max profit $4,000 and the underlying price. So now let's simulate some things. So as I start moving, this is today's date. So as I start going closer to expiration, you'll see that this purple line starts decaying. So my theta will start increasing. You see that I'm now gaining $755. If on 6th of January, which is one day before expiry, this is what my profit will stand at if everything else remains the same, right? Volatility remains the same. This is what it is. And just one day, so you can see as I increase, go past. So it starts moving slowly, but you can see that it moves very fast on the last few days. That's because of the gamma. You see the gamma here. The gamma is going to keep increasing. So there's a big risk towards the end, right? So it makes a big jump. If the price stays fixed on this particular price, then of course I make all the profit. But typically, towards expiration of options expiration, there's a lot of volatility, and gamma comes into factor, right? So you can see the Greeks out here. So let me go back to today again. So this pink line is the profit loss diagram, or basically as it stands today, the payout diagram for today. And as I start going closer to expiration, you'll see that it starts matching this iron condor line. Okay, we got 10 more minutes. Okay, and the other things you can see on, I think, this metric. So for example, you can also simulate what does the gamma do on this. So gamma, I don't really use this tool much, but this is going to show you what your loss is going to be just from gamma as you come closer to expiration, right? So you can see what the gamma curve looks like. What does the delta curve looks like, right? So you want the underlying to be within this price. I guess I'm not very familiar with these tools, but most of the time I just use this on profit loss from open, since open. So go to today. So this is what it is at. And like I showed you, you can start with one vertical like this, and you can add a vertical. Then you can also roll the sides. So I can, for example, let's say the price, the underlying price moves here, right? So in this range, now it's out of my profit, out of my cone of profit, and it's in the loss. So what I can do is I can roll this side forward, which is my put side, to collect more premium, and so that I try to capture the more profit here. So let's see if I can do that from here. So I'm going to, let's say, I'm going to roll this particular, I'm going to basically, I can't do it on a simulation, I guess, or let's try it. So I'm going to analyze opposite trade of this, and I'm going to close out this position, and then I'm going to add another position, create duplicate, analyze trade, and I'm going to move this closer. So let's say we make it 290. I sell the 290 and buy the 285. So now you'll see that here, and let me close this. So what's going to happen now? Let's see. So this is my original iron condor, and I closed out one side. I closed out this side because the price has moved to here, and I rolled it up essentially to bring it closer. So now I've collected. So you can see that now my max loss is 680 and my max profit has increased. And this, what happens in that case, I'll just show you. So let's say my original iron condor was like this profit loss diagram, and now since I rolled it up, it goes. Sorry, my drawing is bad. And if I keep rolling it up more, it will go this way and shift up and higher to one side. So I collect more money, and so I keep rolling on one side. I collect more credit, and then my profit increases and my loss potential decreases. So just quickly here, I'm going to just show you what happens. So this is the original iron Condor, right? And you'll see, watch this number, 930 is my max loss and 4,070 is my max profit. So once I close out this side and I roll it higher, now you'll see that my max loss is 680 and max profit has increased 430 because I've collected additional credit of 2.25 as of today. But on that particular day, if volatility is gone higher, I might get more credit. And it depends on the options pricing on that particular day. So hopefully that was very quick, Srinivas, but hopefully that helped you.
No, thank you so much. So, but you basically roll the side that is more safer, not
exactly, because you want to collect credit and you want to shift this side. You know, practically what could happen is that the price has moved up temporarily, but it can come back into the cone of profit, right? Right. So you don't want to, the side that is being tested, you want to leave that alone. And this side, which is the safer side, you just roll it in higher to collect more money so that you shift the cone of profit more and try to towards this thing. So the moment you do that, you'll see that now my break even here is 300 and this is only simulation, but now my break even should shift higher to this side and it might even shift past this price.
Got it. And when you roll in, you do it for the same time period again, same expiry.
Yeah, I mean, there is so many ways that you can play iron condors. You can, you know, if you can keep rolling it in terms of time, like you roll it to the next expiration. But if I've done my calculations and done my analysis up to a certain expiration, I think that's going to happen. Let's say an earnings is coming up or some event is coming up. I don't know after that, I don't want to carry more risk. So I typically do it for the same expiration, but it depends on your outlook. Right?
Would you ever roll even the side that actually breached at some point, or you know, you just
no, that you are going to usually you want to roll for a net credit because you don't want to lose for a net debit, because if you roll that side, you are now putting good money after bad. Essentially, you are already losing on that, and you'll have to pay more money to roll that side in.
But if you get credit, then you could do that too, right?
You cannot get a credit if the side is being breached. And there's no way you can get a credit.
Oh, okay.
For that, because you are already it's out of the money, or it's in a loss situation.
Yeah, it's already in the money in that case.
You have to pay more to shift that side.
Got it, sir. Thank you.
Okay.
Thank you for coming on. That was great. Awesome job, Raj. We're right up against the hour, my friend. Boy, it goes by quick.
Yeah. For sure. Thank you, Will.
You're super helpful to the community, Raj. Again, I put Raj mentioned his last webinar about iron condors. I put that link in both the YouTube chat and the Zoom. I recommend everyone rush out real quick, hit that link, watch another hour of Raj. You can never get enough Raj. We will see you in a month, my friend. Thanks again for everything.
Yeah, thank you, everybody. Happy holidays, Merry Christmas, and market is slow. Everybody's slow. Just relax and hibernate, I guess.
Yeah, actually, don't be afraid to DM Raj on that Discord chat. He'll take any questions. He is super helpful.
Yeah, I try to be more active on that. And if there's a question directly for me, of course I'll help. I'll try to help as far as possible. I'm not, by no means I'm an expert or anything, but whatever I learned, I just want to help others with that.
You're a given man, Raj. Thanks so much for helping everyone.
Thank you, Will. Thank you for having me. And looking forward to seeing you. Happy holidays, everybody.
Everyone have a great holiday, a great new year, and join Dimitri and I in the morning for any of those questions that didn't get answered tonight, or just come over and say hi. We are on the YouTube channel in the morning. I put the link to that every morning live. All right, Raj, have a great night.
Thank you. Thank you, everybody.
Bye, everyone.
Bye.